Investing can be an intimidating concept, especially if you're new to the game. But with the ever-rising cost of living, putting your money to work in smart investment options can help you achieve your financial goals faster. Whether you're saving for a down payment on your dream home, planning for retirement, or simply looking for a way to grow your wealth, investing is a great way to get started. It's also never too early to start dipping your toes into the investment waters and start building your portfolio. In this video, we'll introduce you to some key concepts on where $1,000 could be invested, giving you a solid foundation to start your investment journey on the right foot. As always, do note that this is not financial advice, as this is merely for educational and entertainment purposes. That said, let's dive right in. Overall investment strategies. At its core, you can think of investment strategies in terms of three main categories: short-term investments, long-term investments, and asset allocation. As its name implies, short-term investments are those that you may not plan to hold for a long period of time. These investments can include things like bonds or money market accounts, and offer less risk than long-term investments, but also less potential for growth. These are usually also easy to switch, with low or even zero costs involved. Long-term investments, on the other hand, are those that you plan to hold onto for many years, or even decades. These investments are typically in assets like stocks or mutual funds, and they offer the potential for significant growth over time. Finally, asset allocation is the process of dividing your portfolio among different types of assets to reduce risk and maximize returns. By diversifying your investments, you can increase the likelihood of achieving financial freedom in the long run. Let's dig a little deeper into each of these in turn. Short-term investing. Short-term investments are less risky, have a shorter maturity period, and offer quick returns. They're perfect for ensuring that cash is available on reasonably short notice, which could be 12 months or even much less, depending on the asset type. They can also be a good starter for those just dipping their toes into the investing game, since they normally carry less risk and can be less volatile. Some typical short-term investments include high-yield savings accounts, certificates of deposits or CDs, and money market funds. Each of these have the common characteristics that we spoke about. High-yield accounts are often a good way to maintain easy availability to cash, while earning enough interest to at least match the prevailing inflation rate. You can often find the best rates at digital banks or the digital arms of traditional banks. Of course, you should ensure that any bank you deposit your money with is insured. Whether with the FDIC in the US, the FSCS in the UK, or whichever the designated deposit insurer is where you live. They can be a great addition to an investment portfolio to help smooth out the peaks and troughs that can be more prevalent with long-term investments. Money market funds, on the other hand, are a type of investment vehicle that allows you to invest in short-term debt securities with low risk and high liquidity. These funds typically invest in government and corporate debt securities with maturities of 1 year or less, such as treasury bills, commercial paper, and certificates of deposit. Some money market funds have minimum investments that can be as low as $1, which make them accessible to all. They are also regulated by the Securities and Exchange Commission, and are generally considered a safe and conservative investment option for those looking to preserve their capital. Long-term investing. One of the most effective ways to build wealth over time is through long-term investing. Such investments are often characterized by their ability to generate significant capital growth over extended periods. Examples of these types of investments include stocks, mutual funds, and exchange-traded funds or ETFs. By investing in shares of companies, individuals can become partial owners of profitable businesses that have the potential to grow in value over time. Mutual funds, on the other hand, offer investors the opportunity to diversify their holdings across a range of different assets, helping to mitigate risks and maximize returns. ETFs, which are similar to mutual funds but trade on stock exchanges like individual stocks, offer additional flexibility and transparency. This is because picking individual stocks can sometimes be a risky strategy, as it requires a lot of information and research. ETFs are often the asset of choice for beginner investors, or those who prefer a more hands-off approach to investing. There are a wide variety of ETFs in the market, offering exposure to different industries and sectors, and even other asset types such as commodities or currencies. But a popular choice are index-linked ETFs, which track the performance of common indices, such as the Dow or S&P 500. These include ETFs from many well-known providers, such as Vanguard and BlackRock. And the great thing is that, like shares, many brokers such as Charles Schwab and Robinhood now provide these in fractions. Which means that you can buy into these ETFs for as little as $1. So having an investment pot of $1,000 is no barrier to buying into ETFs and getting started in long-term investing. The other advantage of ETFs is that they usually have much lower fees than mutual funds. This means that more of your money is put towards the actual investment, rather than being sunk into management fees. While these types of investments may require patience and discipline, they can provide a powerful means of building wealth steadily and reliably over time. Asset allocation. Asset allocation is the way of bringing the two earlier pieces together. Making all your investments long-term is not always the best way to go, as there is a risk that you will face a shortage of cash, or what's known as a liquidity crunch. The other likelihood is that your investments will gyrate too much for you to stomach. You will certainly need cash to meet your daily and monthly expenses, and having all of it tied up in long-term illiquid investments is not going to cut it. And going through fluctuating markets and seeing your investments yo-yo in value may cause too much stress for you to bear. That similarly, you'll be missing out on really generating wealth through higher returns by limiting yourself to only short-term investments. So savvy investors will never have only a single asset or investment type in their investment portfolio, and they understand that proper asset allocation is crucial to achieving their financial objectives. Careful planning and dividing investments across different asset classes can help mitigate risk while also maximizing returns. Additionally, investors should regularly review and adjust their investment strategies as their financial goals evolve. By taking a proactive approach to investing, individuals can ensure that their portfolios are optimized to achieve their long-term financial objectives. Diversifying your investments. An important subtopic of asset allocation is diversification of your investments. The main aim of this is to ensure that your portfolio is well balanced. By diversifying, you can help to lower the risk of any one type of security or asset that could drag down your investment returns. This means investing in a mix of stocks, bonds, and other assets to create a healthy balance. A diversified stock portfolio, for example, is one that includes a variety of investments from different industries and regions, and is designed to be resilient in the face of market fluctuations. And by investing in a mix of different assets, you can help to mitigate the risks associated with investing while still enjoying the potential for long-term growth. Also, as we touched on earlier, investors can split even a small investment amount into multiple different assets, thanks to the power of fractional shares. Ultimately, diversification is key to building a strong investment portfolio that can weather a range of market conditions. A well-diversified portfolio should also take into account an individual's age, risk tolerance, and financial goals. Typically, a younger investor with a longer investment horizon can afford to take on more risk and allocate a higher percentage of their portfolio to equities or stocks, or ETFs that are based on these asset types. On the other hand, a more mature investor who is relatively closer to retirement may want to focus more on income-generating assets, which could be the short-term investments that we went through earlier. So the other key to successful investing is understanding what your situation is, and then developing a personalized strategy that is customized to that. Check out these videos next to find out even more about investing.